All right, so this is the 2017 marginal costing question. It mixes up a little bit of flexible budgeting into the middle of it. It was very similar to what was on the 2019 mock. So part A is calculate the variable and fixed elements of factory overheads using the high-low method. So the high-low method is high-low and difference, and it's used as a simultaneous equation around units in euros. So we go output and overhead or euros. So we just pick any two levels of these. So it doesn't have to be the highest and the lowest. It can be any two. So I'll just pick the first two. So we'll go 90,000 high, and the overhead of 90,000 is 330,000. And the overhead at 50,000 is 210. So the difference between the two of those is 40,000 and 120,000. So the high-low method says to find the variable cost per unit, you just divide those into each other. So we take the 120 divided by 40. So the variable cost is €3 per unit. Okay. Fixed cost then is we take any number. So we'll take the 210,000 and we're going to take away from that €3 by the number of units. So 3 by 50, which is 150. So 210 minus 150,000 gives you a fixed cost of €60,000. Okay, so that's the high-low method. That's part A done. Part B, calculate the company's break-even point. So break-even point is fixed costs over contribution per unit. So to find all that out, you have to do a marginal costing statement. So that's our working basically. So we'll do our marginal costing statement. So marginal costing statement is sales less variable costs equals contribution. So all right, so the sales, and we have to do these per unit as well, if you remember. So sales is 1320, and per unit, you take the 1320, you divide it by 60,000. Okay, €22. Variable costs. Well, we can assume, well, it tells you the materials and direct labor are variable. So the materials are 270, and the direct labor is 207. We've worked out with factory overheads that they are €3 per unit. So 3 by 60 is 180,000. Okay, that's the variable cost. Then does it tell us any more? This is apart from sales commission of 5% of sales. Now I'm going to put that as separate. Now it is a variable cost, right? But what I want to do is total them. And you'll see why hopefully later on. Then I'm going to put in my sales commission. It's still a variable cost, and it's 5% of sales. Which is 66,000. All right, so apart from that, the rest is fixed. So I need to do these per unit. So we take the 657 and we're going to divide that by 60,000. It's always divided by 60,000 units. And 10,950 divided by 60,000, or sorry, 66,000 divided by 60,000 is 1.1. So the contribution is sales minus variable costs. So 1320 minus 657 minus 66 is not false, is 597, and 22 minus 10.95 minus 1.1 is 9.95 per unit. Okay, so the fixed cost then, that contribution per unit is going to be quite important. The fixed costs, we've got our, well, none of material, none of direct labour, but some of our factory overheads. We worked it out to be 60,000. We know that the rest of our selling expenses, so the selling expenses minus the commission, so the commission was 66. So 82,500 minus the 66. And then finally, all of our admin is 101,250. Now you will know you've done this correctly when you add these together. Sorry. When you add them together and take them away, you get 419,250, which is the same answer as you get there. So the net profit is 419,250. The important numbers, that one, that one, that one, and that one going forward. Okay. So break-even point. So you just know your formula. Break-even point is fixed costs divided by contribution per unit. So fixed costs 177,750, and we're going to divide that by the contribution per unit, which is 995. Which is 17865. Okay, the margin of safety is the difference between the amount you need to sell, or the amount you're selling, 60,000, and the amount you need to sell to break even. So 60,000 minus 17,865. Which is 42,135. Okay, so that's part B done. Part C, all of these are little marginal costing questions from here on in. So calculate the number of units that must be sold at 25 to make a profit of 10% of the sales revenue earned from these sales units. So we got sales, variable costs, commission, fixed costs, and profit. And we're trying to find out the number of units that must be sold at 25. So if the selling price is 25, how many do we need to sell? Call that N. So sales will be 25N. Variable cost will be the same, 10.95 per unit, so by N. So that'll be minus 10.5N. commission is still 5% of sales. So 5% of 25 is 1.25. So that's 1.25N. And the fixed costs remain the same. Fixed costs are 177,750. And the profit is calculate to make a profit of 10% of sales from the same unit. So sales is 25N, so 10% of that is 2.5N. So then it's 25N minus 10.95N minus 1.35N minus 177,750 equals 2.5N. So if we just work out those sums, so bring all the numbers to one side, so take minus 2.5 basically away and bring the 177,750 to the other side. So it's 10.95. So that'll be 10.2N is 177,750. So then it's divide them into each other. N is 177,750 divided by 10.2, which is 1746. Sorry, 17.7. So it should be 10.3. It's telling me, so I've made a mistake here somewhere. 25N. 12.2. 25 minus 10. 25 minus, sorry, 12.2 minus 2.5, 10.3. So it's 1725, 7.28. So 17,258 is the answer there. All right. Part D, calculate the selling price that must charge if fixed costs are increased by 12%, but the volume profit remained the same. So this time the price is what we're trying to find out. So the volume remained the same. So sales is 60,000 and we're multiplying by the price. We need to find the price we're going to charge. So 60,000p. The variable costs remain the same. So the variable costs remain 10.95 by 60,000. And the commission is 5% of 60,000, which is 3,000p. Okay, Um, Fixed costs are going up by 12%. So fixed costs are 1177750, and we're going up by 12%. So that's minus 199080, and tells us the profit is remaining the same. So the profit has still got to be 419250. So now with 60,000, 57,000 or 60,000p minus 657 minus 3000p minus 199080 equals 419250. So bring the p's to one side. So 57,000p is 419250 plus 657 plus 199080. So divide them into each other. And that'll be equal to 22.37 cents. So 22 euros 37. So I'll come back to this, lads. I'll do part D in a bit. Sorry about that. I'll just finish off part D now. Something about doorbell rang, so didn't want a big long pause in the middle of it. Right. Part D is sort of a flexible budget. Well, it's not really. It's more the same. It says after conducting research, they've given two options. Which one would you recommend? So option one is reduce the selling price by 10, spend an extra 30,000 on advertising and increase sales volume by 20%. It's the same sort of thing. You just go sales, right? Variable costs, commission, fixed costs, and profit. So option one is reduce the selling price by 10%. So at the moment the selling price is 22. So we bring it down by 220. So it goes down to 1980. So selling price is that. What's happening to the units? So the volume is increasing by 20%. So at the moment it's 60,000. So 60,000 plus 20% is 72,000. So 20% of 60,000 being 12,000. So it's going to be 72,000 units. So 1980 by 72,000 units. The variable costs are going to remain the same. So they're still 10.95. And we're going to multiply that by 72,000. And the sales commission is still 5% of sales. So 5% of 142,500 is 71,280. Fixed costs. Well, the fixed costs are going up by 30,000. So anytime there's a number, that's fixed cost. So the fixed costs are 177,750, and adding on another 30,000. So 207,750. So our profit then Just taking those changes into account is 358,170. Okay, the second option, spend 40,000 on leasing a new product. Well, just sales, variable, commission, and fixed. This will reduce the variable cost by €2 per unit, maintaining sales at current levels. So we're keeping 60,000 as our sales. So it's going to be the same price. So 22 by 60,000. The variable cost is going down by 2 per unit. So it's going to be 8.75 by 72,000. And the commission will still be 5% of sales. Fixed costs need to go up by 40,000. So fixed costs for 177,750, and they're going up by 40,000. Okay, so if we check those sums, our profits are 406,250. So we'd say, well, which is the better option? Well, option 2 is the better option. See, there's that number right. So I've put in the wrong number there. Okay, option 2 is the better option because the profits are higher. Okay, last question, sensitivity analysis is what if analysis. So what if something changes? So it's everything we've been doing. So what if selling price changes? What if volume changes? What if fixed costs change? What if variable costs change? What impact do they have on profit? And that's all you say for what if analysis is. Our sensitivity analysis is, it's what if something happens. Okay, so that's that done. Hopefully that was quite straightforward. I'll have question 9 done next.